In this lecture, I'll explain the difference between trading the majors, minors, and exotics. Now, the majors are all made up of the US dollar on either the base side or on the quote side. Okay, so these are all of the major pairs. Minors do not contain the US dollar. Okay, so it's anything from euro pound to CAD yen. And exotics are currency pairs that contain a major, and they're matched with the currency of an emerging or a strong but small economy from a global perspective, such as Hong Kong or Singapore and European countries outside of the Eurozone. For example, Euro, Turkish lira, or the US dollar versus the Hong Kong dollar. Now, the difference between trading majors, minors, and exotics, it's mostly the pip spread. So if we take a look at USD yen, the pip spread here is about 2 pips. Okay, and let's take a look at a minor. So CAD yen, the pip spread here is about 3 or 4 pips, give or take. And an exotic, like the euro lira, the pip spread is, it's about 16 pips. Okay, so this is something that you guys have to pay attention to, because there's a larger buy-in commission required to trade an exotic versus a major and a minor. Okay, so for example, if I were to trade USD yen, and just pay attention to the terminal down below. So if I bought this, the pip spread is 2 pips. So if I bought one standard lot, oops, sorry about that. Let me just do that again. So if I buy one standard lot, it costed me about 20 bucks. So I was negative $20 the moment I entered the trade. Now, if I were to trade the euro lira, just pay attention to my terminal down below, just buy this, you see that costed me about $60. Okay, so it's a lot more expensive to trade an exotic versus a major or a minor. Okay, so that sums up for this lecture. In the next lecture, I'll explain the difference between trading gold versus oil. In this lecture, I'll show you the main difference between trading stocks and trading Forex in terms of commissions from the broker side. Now, we already know when trading Forex, the commission comes from what's called a pip spread. And the pip spread is the difference between the bid, which is on the left side of your trade terminal where it shows the price. So in this case, the bid is 78.30 and the ask is the 78.33. And the 78.33, this is the raised price that the broker raised it to, basically so that they could make a commission off of every trade that you make. Okay, so we already know this because we've went over this in previous lectures. Now, with stocks, there isn't necessarily a pip spread, and instead most brokers would charge a flat rate of around $10. Some brokers might also include a small spread as well as the $10 buy-in. So that's something that you want to watch out for when deciding on a stockbroker. So I've been using CMC markets for the last several years now, and I would highly recommend using these guys if anyone's interested in going and trading stocks. I'm not going to go over too much detail how to use the trading platform in this lecture, but I will definitely create some videos later on in the future where I give you guys some tutorials how to use this CMC interface. So as you guys can see here, if I just take a look at this is a Royal Bank of Canada stock with the TSX. So there is actually a small spread here, and it's 1 cent. So if I were to purchase 100 units, there would be the 1 cent spread. So it's not pips in stocks, it's just the last, it's the cent. All stocks are probably a little bit different though. Let's take a look at Apple for a second. Okay, so if I were to buy Apple again, yes. So here it's a 1 cent spread, but then there's also the $10 buy-in. So I would highly recommend anyone that's interested in stock trading to take a look at CMC Markets. They have the online application, which is available for all desktop and mobile devices, and they also have the apps available on Android and iOS in the App Store. I've always recommended anyone that gets into trading not just to focus strictly on currency pairs. You should also diversify your trading assets with stocks. Sometimes with trading Forex, it's sort of a patience game where you have to wait for the right trade setup to come along and then finally execute a trade. So if you're the type that finds you might become a little bit impatient in times and you trade a little bit too early, then it's a good idea to start looking at some stocks to pass through some time. So then that way you're not so eager to execute a trade. I know it can be very exciting, especially on one day if you make a couple $1,000. It's very natural for anyone to want to do that again. But it's always very important that you maintain good discipline and are very patient when it comes to trading. So take a look at some stocks, create some trade setups on some stocks that you like, and once the market starts moving in that direction where you want it to, then you can then decide if you want to get into some sort of short, or if you want to get into a long position, or if you're just going to wait it out even further. So it all really depends. Okay, so CMC Markets, guys, is who I recommend for going with stock trading. Thanks for watching. Hello traders, and welcome back. Congratulations on completing the first section of the beginner course. I know I went over some of the basics, and I hope you guys learned quite a bit. This is the most exciting part of the course, where I will be now introducing you guys to price action trading. In this whole second section, I'll be teaching you a lot about technical analysis, how to read charts. I'll show you some continuation patterns, reversals, and all of these strategies and techniques that I'll be introducing you guys to are used by world professional traders making high profitable trades every single day. And hopefully you guys really understand this course material. I'll take my time to really go through it so that you guys fully understand it, and I'll do my best not to bore you guys and just try to show you and teach you guys everything that is most important and what you really need to know. I know there's a lot of stuff out there that can be confusing for a lot of newcomers. I'll do my best to sort of explain and filter out all the stuff that you don't need, and just give you all of the good stuff that you do need to know. I don't want you guys learning any bad habits, so I'll teach you all of the good ways of trading at a very early stage. So congratulations again on making it to the second part of the beginner program. So now what I want to do is basically introduce you guys to candlestick analysis. So there's a website here, it's called Investopedia, and so you can go over to investopedia.com, and I'm just taking a look at this site because it has some good explanation as to what each individual candlestick means. It gives you the name and all that stuff. So you guys can go over to the site whenever you like and explore all of the different types of candlesticks and the names, and get an understanding of what each of them represent, because it's good to understand them and see them in action, because then you can relate to some of the textbook stuff, and see it practically and trade it accordingly. But just because it's like that in textbooks doesn't necessarily mean it's always going to be 100% accurate. So that's the difference between textbook trading and real actual trading.
So use the textbook stuff wisely. Don't just strictly rely on it. Just just for example, let me just pull this up again. I'll just go down to one of these candlesticks here. So this candle here is it's called a hammer, and a hammer is an inverted hammer. Sorry, this is the inverted hammer, and this is the hammer. A hammer is a reversal candlestick pattern that happens. So when the chart is in a bear trend and it comes to a bottom and we get this nice long wick to the downside, and then the candle is actually a bullish candle. So the white candles here are bull candles and the reds are the bear candles. So red is going down, down, down. And when we get this candle at the bottom where we get a nice long wick and then the body is actually a bullish candle, that typically means that this pair is either going to face a bottom, or we might actually get some sort of reversal or some sort of retracement in the short term. But just because we see a hammer doesn't necessarily mean it's always going to do that. Okay, so there's lots of different candlesticks that look like hammers. This is always a good practice to sort of look at some of the reversal patterns, some of the names of the candlesticks, and just go through the chart. I like to just scroll back in history and try to see if you can spot any of them. This is a really good practice. This is what I used to always do when I was starting out, and this is what I recommend to all of my students. Go back in time and see if you can spot a hammer, for example. Okay, so and a hammer doesn't necessarily have to be exactly like it looks like in the textbook either, guys. Like, it doesn't have to be exactly like this. Sometimes you'll see a little wick on the upside. Sometimes you'll even see the candle body. It's still a bearish, so in this case it would be black instead of white. It is definitely better to see a bullish hammer, which that's what this is here. I mean, bullish in the sense where the candle body is white, so it's a bullish hammer, excuse me. But even where we see black hammers still could give us a clue that we might see some sort of reversal. This actually here could be looked at as a hammer. We are looking at this on a 4-hour. Okay, and I also want to show you guys the difference between looking at candles on different time frames, and because just because this looks like a hammer on a 4-hour, we might see some sort of different candle pattern on the smaller time frames. Let's just go ahead and take a look at that and see what we can dig up here. So I'm just gonna insert a rectangle just right on top of this hammer here. Okay, and because what I want to do, I'm just gonna try this again. Sorry about that. Okay, because what I want to do is just see what it looks like on smaller time frames. So there you go, right? So that's what on a 4-hour time frame, this is what a hammer looks like. Okay, sorry, this is on a 1-hour. So this is what it looks like on a 1-hour. But if we switch over to a 4-hour, we get the hammer. Okay, now we also have the inverted hammer. Okay, which is where we get the wick to the upside, candle body on the downside. An inverted hammer is kind of similar to a shooting star, and I thought I just saw one. Where was it? Here, right over here. Okay, so we're getting this sort of uptrend, and then we get a shooting star. So we get the long wicks to the upside, candle body, different color. So it's a bearish candle to the downside, and it shoots it down. Okay, so guys, take your time going through Investopedia, understanding the different types of candlesticks. But what I'm going to do is just basically give you all of the candlesticks in a nutshell, so you don't have to remember all of the names. I'm just going to teach you what's most important. Okay, so what's most important about candlestick analysis is understanding the size of the candle bodies and understanding the wicks. Okay, so the candlesticks that have little short bodies and they're little, like these little guys here, this is called the doji. Dojis mean indecision, so the market is unsure of whether it should go up or down. It's not really giving you much information. When we start to see candle bodies start to pick up in the size, it means that the momentum, like you can visually see the momentum is getting stronger and more aggressive, okay, in these candle bodies. And then, so for example, as we start to pick up this bullish momentum and we get shot down by this bearish candle here, okay, that's sort of signaling that this upswing here is about to stall out a bit, and so we get this little bit of profit taking mode, okay. And you have to take into consideration, it's all about market psychology, right? What is everyone looking at? So for example, if you entered a trade here based off of this doji and there was a little indecision, just you could have thought, okay, we're getting this upswing and we're getting a little indecision happening here. This might be a good opportunity to go long and place your stop loss down below here. If you did decide to get into a position here and you're holding on to it, who knows how much you're up at this point, but then you see this strong bearish candle wipe out this bullish candle. It's all just market psychology here, guys. Like, you might be a little concerned that this might continue to fall downwards, so you might close your position, and you know what? Other traders are doing the exact same thing. You can just imagine, like, if you're a big time trader and you made a trade down here and you closed it up, or your position's up here, and say you're up, $10 million, right? And so all of a sudden you get this red bearish candle, and instead of being up 10 million, well, now you're only up 6 million. So you're like, okay, forget this, I'm just going to close this position. And you know what, other traders are doing the exact same thing. So this could be looked at as sort of like a little profit taking mode. Like, the bullish trend is still intact, it's just we get this little hiccup here, this little downswing, just based off, it could just be strictly profit taking mode for a lot of firms, institutions. So that's something to think about. All of this, reading candlestick analysis is all about just understanding the psychology of it. Okay, so like when we see a lot of wicks to the downside, sometimes we get movement to the upside. Like we're getting, like, price action wanted to fall and was unable to hold on to those gains, and it continued to move upwards. So like, we're getting wicks to the upside. So sometimes that's a good practice as well, to just pay attention to the wicks. Like when we get wicks to the upside, we go down. Wicks on the bottom, sort of consolidating. More wicks on the upside, we're going down, and so on. So, this is a good little practice as well, to go back in the history, see if you can spot candles that have long wicks on the upside, and just predict what you think will happen next. So you can just press the right arrow key on your keyboard like that, and you can see what candles come up next. And so, as we start to see candles on the bottom, what tends to happen, and so on. So it's a good little practice for you guys to go ahead and do that. That kind of sums up technical candlestick analysis in a nutshell, guys. There's lots of different patterns. Like there's the evening stars. So like you get like a sort of a bullish candle, a little doji at the top, and a bearish candle afterwards, and that tends to clue in that it's sort of a reversal. But again, like I said, nothing is 100%. Even like this could even be looked at as sort of like an evening star in Forex. This little pattern here, these three, right? But just because it looks like an evening star, or even if it is an evening star, doesn't necessarily mean that it will reverse. In this case, it did. But don't just strictly rely on candlestick textbook information for making trades. You have to have more confirmations. There's a lot more to it, but definitely get a good understanding of how candlestick analysis works. Spend some time on Investopedia.com. Become familiar with candlestick analysis, because the more you know about candlestick analysis, the better off you guys will be. Okay, so I'm going to leave it there for now. In the next lecture, I'll be talking about spotting trends.
Hi, in this lesson, I will be teaching you how to spot trends, learn the various types of trends, and learn how to start trading these trends. So there are actually three types of trends. You have an uptrend, you have a downtrend, and you have a sideways trend. These are the three major types of trends. Now, what we're looking at here is Aussie USD on a 30-minute time frame. If I were to switch this over to a 1-hour time frame, we see that the trend is actually a little different. We have trends within trends. So on the smaller time frame, we have an uptrend, a downtrend, and a sideways trend. But on the larger time frame, we could also look at this as one long sideways trend. And majority of the time, the market is continuing to consolidate. In other words, the market is continuing to trade within a range or within an up and down pattern, typically sideways motion. However, this trend can also be traded in a rising channel. Let me just delete some of these to explain. So the rising channel would look something like this. So it's trading within this channel here, or you have the declining channel as I outlined before, which was this. So this is the declining channel. Okay. So what I'd like you guys to do is go ahead, look at your MT4 platform, and try to spot the trends. Try to spot and identify if the trend is moving sideways, if it's moving upwards, if it's moving downwards, and so on. And what I'd like you to do is take a look at the trends on the larger time frames. So on a 4-hour time frame, a 1-hour time frame, and even on a 5-minute time frame. So you can see that on a 5-minute time frame, if we were to have a downward trend, this downward trend on a larger time frame might actually look more like it's still trading within either a rising trend, so you have the rising channel, or another way of looking at it is this could very well simply be a sideways trend as well. So there was a slight tilt to the upside in this rising trend, but from this area over to the right, you could also consider that as sort of a sideways trend. So there's a few perspectives, and this is one of the reasons why the market moves up and down, is because of the various perspectives that traders have when analyzing various charts. Okay. So the assignment, guys, is to go ahead and try to spot the trends in your MT4, and once you have been able to do that, we'll move forward with the next lesson.
Thank you for tuning in. In this lecture, I will explain what support and resistance is and how to use it, how to read it. Okay. Now, support and resistance is a term used in technical analysis, and it refers to when price points reach a certain level and are either supported or resisted. Okay, so for an example, right now we're taking a look at USD CAD on a 4-hour time frame, and this pair is trading within a bullish trend, and we can see that it made several attempts of breaking lower than these levels, but it was being supported. So this is what support refers to. And resistance is basically the opposite. Resistance can be on the top. So right now we can consider that we're actually trading within a rising channel at the moment. And when price reaches a certain price point and is unable to break through it, it's being resisted. Okay, now a very easy way of spotting where the resistance is once you're able to identify support is basically just sort of replicate the angle. Okay, so you can see this is sort of the same angle, and you can just basically like mirror it, and that will get you your level of resistance. Okay, so that's only if it's trading within a channel. At times too, you might see the channel widen out or get thinner at near the top. That's common. It's not always like this, but it's very common that you'll see sort of the same thickness throughout the channel as it's continuing to trade. Now, general rule of thumb is that support will tend to hold unless something significantly happens. Now, what could be something significant that could happen that would break through a level of support? Well, it could be something related to fundamentals like say for example GDP or some sort of economic report came out, and it was, it might have been consolidating heading into the report, and then once the report was released, it then caused either a breakout to the downside, so it broke below this rising support, so it broke out, and then it might fall down to another level where we might see some sort of support. So for example, if we are able to crack below this rising support level here, the next level that I would look to for sort of a retest would be this area here, because we had some sort of support in the past. So this is on a 4 hour, so whatever happened here for it to consolidate, I would expect some sort of retest of this level before breaking lower. So we might see something like this, and then sort of a bounce, okay, and then we might get continuation to the downside like that. Now, support and resistance, like I said, does tend to hold unless something significantly happens. And how are we able to tell if support and resistance is going to hold up or if it's going to break? Well, in most cases, whenever we see some sort of momentum coming down to a level of support, that's when you sort of want to be cautious, or momentum rising up to a level of resistance. Again, that's when you want to sort of be cautious that the level might break. Okay. But there are times when we might start to see a bunch of smaller candles developing, and it's sort of like an indecision, candles, dojis, and stuff like that start to develop, and it's showing that there's sort of lack of momentum in the marketplace. And so like when we get lack of momentum in the marketplace, chances are we will see a bounce if it reaches a level of support or resistance. Okay, so support and resistance can be on on an angle. It can also be horizontally. So here in the past we saw that this level, we were getting lots of resistance here, and then finally we were unable to break above, and we continued to sell off. Okay, and let's just take a look at some more examples. So here we have the pair selling off nicely, and there was sort of a smaller sort of like a very light level of support. So it was supported, and finally, like I said, when support is broken, it then becomes resistance. So here support was broken, it's now being resisted, and finally once we were able to break back above this level of resistance, we're then being supported again. Okay, so that's USD CAD on a 4 hour time frame. Let me just zoom out to a daily. Okay, Now, when drawing in support and resistance on larger time frames, they definitely hold up a lot stronger than on smaller time frames. So like if we were to draw in support and resistance on, say, a 5 minute, you know, the support and resistance isn't all that strong. The reason for that is because you have to think of it from a market psychology perspective. When we look at the daily, there's more traders looking at these levels, okay, versus a 5 minute, right? It all really depends on the trading session as well, who's all trading, who's all in the marketplace at the particular time. But you can imagine that support and resistance on larger time frames does definitely hold up a lot stronger because more traders can see it. More traders are looking at the exact same thing, right? So for example, here in the past where we had this sort of level of support, this area here, right? It's basically, it held up because, lots of traders are looking at the same level. If you're looking at buying USD CAD on a daily and you see these lows here, you saw sort of this low was tested and then immediately it was rejected, and you might have missed that opportunity, and then sort of a few weeks passes and you look at the charts again and you're seeing that the same low that was rejected previously, we're now at that price point again. Chances are there's gonna be buyers in the marketplace, right? Because more traders are looking at this. So that's why the daily or the larger time frames holds up a lot stronger than the smaller ones, because it just allows more opportunity for more traders to look at the charts and see the opportunity available. Okay. Also, I just want to go down to a smaller time frame as well, just to explain how sometimes when we have these levels of support or resistance, there's ranges within ranges. So this could be considered a declining channel, but also within this channel we have sort of a mid channel. So you can see that there, right? And it's funny the way it works is because like the thickness of each of these channels here is a way that you can sort of predict where we might see some sort of resistance afterwards. So if I were to just basically measure the thickness of each of these smaller ranges, and just place it right there, you can sort of visually see. That's why we sort of got this level of support here where it sort of just rounded it off, right? Because they're all pretty much the same, and we can do that again here as well, right? So you can sort of just keep building it, and it works great. Tends to work. Doesn't always work with all pairs, so but it works great with the USD CAD. So that's something that I always do. I always, whenever there's some sort of breakout, I want to place a target, and in order for me to know where I should place my target, well, I'm just looking at the previous heights, thicknesses of these ranges, and then I'll basically build upon it and take it from there. So if I were to get into a trade here, I would only be looking to target this, and that the reason I put my target there is because I have this, I just drew in the thickness, right? So that's sort of lots of levels of support and resistance there. They're also known as pivot points. So pivot points work really well. I'm going over pivot points actually a little bit further in the next video. I'm actually sort of jumping ahead. So tune into the next video and I'll show you some more about pivot points. In this lecture, I will be explaining what pivot points are and how to use them effectively. Okay, so in the previous lecture, I was explaining some support and resistance, and with support and resistance, we sometimes will have mid-range pivots or mid-range support and resistance levels. And when we're able to define one of the major channels or one of the major ranges, which could be on a diagonal or it can be horizontal. So for example, over here, if I were to draw in, so first of all, what you want to do is just draw in the most obvious. So this is quite obvious that it's being supported here. And then, this is also quite obvious that it's being resisted along the top. When we are able to define the most obvious, then we can define our mid-range pivot. Okay, and our mid-range pivot tends to be, well, like you guessed it, 50%. So exactly 50%, roughly 50%. So if I were to measure this, just using this drawing tool, you can see that this is sort of the mid-range pivot there. Just go ahead and delete that. And we can see that this mid-range pivot does act as support and resistance. So there are lots of ranges within ranges, and these ranges within ranges act as pivot points. Okay, so we see them on a diagonal and we see them horizontally. And we can zoom into smaller time frames. Okay, and we can find even more pivot points or even more mid-range pivots. So this would be one right in here, as we can see. Okay, and we can simply build upon these. Okay, and the way you want to build upon them is basically just measure the same height, and you can see that these are all very consistent in the heights. I might not have done this exactly 100% accurately, but you guys get the idea. Okay, so those are mid-range pivots. Let me just go back over to a 1 hour. Now, other pivots can be from when we get breakouts and there's a retracement, and when there's a retracement, it doesn't necessarily mean that it's going to go back to a level of resistance. So it might bounce off of sort of a pivot. So if I just take this Fibonacci retracement tool and so here we had a breakout. So you want to, when using the Fibonacci retracement tool, you want to take it from the breakout, so from the highs down to the lows. And because this is the first time that I'm actually using this particular software, the default, it shows up as yellow, which I can't really see. So I'm just going to go ahead and right click, go into the properties, and I'm just going to switch this to black so I can see this a little bit better. And one of the most common Fibonacci pivot retracement levels is the 38.2% retracement. So you can see here, after we got this breakout, we retraced back to the 38.2%, and finally, after consolidating through there for a little while, we were able to come back and it actually came back and tested this level of support, and it bounced off of it as resistance. Okay, but these are levels of pivot levels as well that are most commonly used. And lastly, the most effective pivot points are actually the psychological pivot points, and those refer to the rounded numbers in any currency pair. So for example, if we're looking at, let's just take a look at this on a larger time frame. Okay, so here you can see that usually what happens is like the rounded numbers, so like the 121, so you see that right there, it's 121.02. It's close enough to the 121, so that's the 121 handle. And then around the 122, here it's 122.10. So it wasn't exactly, but that's probably only because the momentum was picking up around the 122 handle. And we also have so like 122 would be a pivot point, and also the 122.50, which is right around here. So those are just psychological pivot points that work great. They usually work with most currency pairs. Okay, so that's it for pivot points. Thanks for watching, guys. Be sure to tune into the next video. Hello traders, welcome back. Michael Harding here from the Academy of Financial Markets. In this lecture, I will be explaining what pivot points are and how to use them effectively. Okay, so in the previous lecture, I was explaining some support and resistance, and with support and resistance, we sometimes will have mid mid-range pivots or mid-range support and resistance levels. And when we're able to define one of the major channels or one of the major ranges, which could be on a diagonal or it can be horizontal. So for example, over here, if I were to draw in, so first of all, what you want to do is just draw in the most obvious. So this is quite obvious that it's being supported here. And then, this is also quite obvious that it's being resisted along the top. When we are able to define the most obvious, then we can define our mid-range pivot. Okay, and our mid-range pivot tends to be, well, like you guessed it, 50%. So exactly 50%, roughly 50%. So if I were to measure this, just using this drawing tool, you can see that this is sort of the mid-range pivot there. Just go ahead and delete that. And we can see that this mid-range pivot does act as support and resistance. So there are lots of ranges within ranges, and these ranges within ranges act as pivot points. Okay, so we see them on a diagonal and we see them horizontally. And we can zoom into smaller time frames. Okay, and we can find even more pivot points or even more mid-range pivots. So this would be one right in here, as we can see. Okay, and we can simply build upon these. Okay, and the way you want to build upon them is basically just measure the same height, and you can see that these are all very consistent in the heights. I might not have done this exactly 100% accurately, but you guys get the idea. Okay, so those are mid-range pivots. Let me just go back over to a 1 hour. Now, other pivots can be from when we get breakouts and there's a retracement, and when there's a retracement, it doesn't necessarily mean that it's going to go back to a level of resistance. So it might bounce off of sort of a pivot. So if I just take this Fibonacci retracement tool and so here we had a breakout. So you want to, when using the Fibonacci retracement tool, you want to take it from the breakout, so from the highs down to the lows. And because this is the first time that I'm actually using this particular software, the default, it shows up as yellow, which I can't really see. So I'm just going to go ahead and right click, go into the properties, and I'm just going to switch this to black so I can see this a little bit better. And one of the most common Fibonacci pivot retracement levels is the 38.2% retracement. So you can see here, after we got this breakout, we retraced back to the 38.2%. And finally, after consolidating through there for a little while, we were able to come back and it actually came back and tested this level of support, and it bounced off of it as resistance. Okay, but these are levels of pivot levels as well that are most commonly used. And lastly, the most effective pivot points are actually the psychological pivot points, and those refer to the rounded numbers in any currency pair. So for example, if we're looking at, let's just take a look at this on a larger time frame. Okay, so here you can see that usually what happens is like the rounded numbers, so like the 121, so you see that right there, it's 121.02. It's close enough to the 121, so that's the 121 handle. And then around the 122, here it's 122.10. So it wasn't exactly, but that's probably only because the momentum was picking up around the 122 handle. And we also have so like 122 would be a pivot point, and also the 122.50, which is right around here. So those are just psychological pivot points that work great. They usually work with most currency pairs. Okay, so that's it for pivot points. Thanks for watching, guys. Be sure to tune into the next video.